Welcome back. I think the big development this morning is the way in which the bond yield has crashed. The 10-year bond yield now at 6.95, a level probably we last saw in November of 2017 or December of 2017. A big development indeed that the bond prices are going through the roof. The bond yield fall obviously because of the GDP number coming in on a 5 handle, and therefore expectations mounting that you should get a strong action from the Reserve Bank. We have perhaps the best of persons to speak about that. Badri Nivas NC, who has just taken over as the head of markets and securities South Asia at Citi, joins in from the sidelines of Citi's 14th India Investor Conference. Good morning, Badri. Good to have you with us. The bond markets are at some near-time highs. 18, 19-month highs. What is the sense you're getting? Are we going to see a lot more fall in bond yields?
Morning, Lata, and morning to your viewers. It's obviously on the expectations from a domestic point of view that there could be more policy actions coming in from the Reserve Bank, both on the rate cut side as well as potentially on the liquidity side. But also it's a reflection of the development, what's happening across the world. There has been a sharp deceleration on the global growth expectations, and most central banks have turned dovish. The US 10-year is actually at 2.12, which has been a level which is again, not seen for a long time. So it's both a reflection of the domestic expectations and what's happening around the globe.
Badri, hi, good morning, and thanks for joining us. So what are you expecting on the yield itself? I mean, it's sitting at an 18-month low now. Over the next couple of months, what could the trajectory look like? And from the RBI, what would your expectations be? Not just in the form of a rate cut, but what could the key liquidity measures be that the RBI can announce?
Firstly, on the rate cut itself, definitely we expect another 25 basis points cut in the upcoming MPC. Just an interesting point would also be what the governor mentioned in New York conference, I think, about a couple of months back, that why should we wait it to a 25 bip step? So who knows, maybe they can get a 35 basis points rate cut also. Importantly, on the whole growth inflation dynamic, it looks like we are in a path, in a time when growth is of a bigger concern. Inflation seems to be well anchored within the range of the RBI's target. And if we have to boost aggregate demand, given the fact that on the fiscal side there is not much space, probably monetary policy has to do a little bit of heavy lifting. So to that extent, you could probably see more than one rate cut in this cycle, at least in the next few months. On the liquidity question, I think it's important to understand that the liquidity shortfall is not necessarily just a systemic or a temporary issue. I think we've been building up a structural liquidity issue for the last few years. There have been a combination of factors for this. Obviously, falling domestic savings because of lower income growth and consumption holding at this point means that we're not having sufficient savings. On the back also, we've had the continued high currency in leakage. The third factor has been the tightening of the Basel norms on liquidity, which make the intermediation costs on liquidity be high. All of these factors means that structurally we have a dependence on BOP or foreign flows to finance the economy. And not all of these are things the RBI can fix in a very short time. But from an immediate perspective, I think it will be useful if the RBI recognizes these structural issues and therefore adopts a policy of a positive or an accommodative liquidity stance. Based on, I think, the way the numbers will work, and if some government spending happens in the next few weeks, the system is expected to turn positive. But beyond that, it will be very important guidance for the market if the RBI or the MPC can actually formally say that they would like the system to be on a positive mode for months to come.
Okay. Point is taken. So your expectation is 25 basis and an accommodative stance. I'll just come to that in a minute. But just how will the market react if it is 35 basis?
I think the market is, if you look at the short-end rates, they are factoring in a 25 basis points cut. But so there can be obviously some consolidation if you deliver only a 25. But if there is 35,
I meant 35,
that will probably be a lot more positive. Yeah, okay. If you get something more than 25, whether it's 35 or whatever, then that will be definitely positive in terms of continuing the momentum of falling yields. In general, I think no one expects this to be like a one cut and done, even if it's 25. So any forward guidance, even if it's not 35, but it's only 25, but a guidance to the fact that we could see more cuts will obviously keep the momentum in play.
Okay, but you didn't answer Sonia's question as to how will that impact bond yields. Is 25 factored in, or when the cut actually comes and it is 25, where do we go to in the 10-year?
Yeah. Okay. So I was just going to ask you, when you say bond yields, which tenor you mean? Because what's happening in Indian bond markets is really the term premia is quite high, right? And increasing, and I think that that's likely to increase. So while the short-end bonds yields are likely to be very well anchored towards the policy rates, on the back end, the 10-year especially, I think it will be a function of course, the RBI rate cuts, but also it will be a function of what happens on the fiscal and the government borrowing. And there, obviously, there is a big challenge for the new government in terms of the budget math. The revenue growth projections that they have had in the interim budget are looking very, very optimistic as things stand at this point in time. And if you pencil in the growth slowdown, then some of the tax, both direct and indirect growth assumptions are obviously going to be a big challenge to meet. And therefore, at a time when the government also needs to be focused really upon, kind of reinvigorating the growth, how do they manage this fine balance on the fiscal is something which it's no mean task, and we are all going to be watching closely. And if the government comes up with a fiscal number which shows a bit of more borrowing, then obviously that's something which the back end of the curve, the 10-year will probably, it will weigh on the 10-year part of the curve. All in all, I think that it is possible that we operate in a 675, 720 range for now. If you ask my bias, I think it will be a little bit towards the downside, but that really depends upon how the fiscal math comes out and what kind of borrowing numbers the government projects.
Okay, what's your view on the currency now? Because the rupee has emerged as one of the top performers in Asia. If you map a 3-month trajectory, do you expect the strength to continue?
Yes, INR has been a good performer through the year. See, what happens is when you get a period of falling or slowing global growth, which is what it looks like at this point, right? And that automatically leads to oil and other commodity prices coming off. What we see in those circumstances is the INR does relatively better than some of its peer group, simply because we are a lot more domestic-driven economy than export-driven economy. So to that extent, I think in the current environment, if we are able to get some of our policy measures to kind of stabilize growth and probably even move it up in the second half as we expect, then I think India will continue to attract some flows, which will be positive for the currency. On a 12-month base time frame, we expect the currency to consolidate towards 68 to a dollar. The big risk is, of course, the geopolitical risks on oil, and that can be a risk to my view. But if oil prices remain benign, we expect that INR can consolidate, especially if we can get some growth pickup towards the second half of the year.
Okay, 68 is quite something. Badri, in that case, you all are not factoring any destabilizing moves from the yuan?
From the, sorry, Lata?
Chinese yuan.
From the yuan?
Yes.
Yeah, yuan. We think that, obviously the trade deal, has not come through, and it looks like with each passing day, the bar to stitch together a deal looks a little, in the near term, looks a little difficult. But having said which, I think the Chinese policymakers have clearly said that they wouldn't, permit a very sharp deceleration beyond 7, and they've kind of warned speculators from taking any kind of position with that expectations. And frankly, they have the powers or the ability to really, moderate. So we think that yuan will depreciate, but in a more moderate fashion rather than any sharp falling off the cliff kind of stuff. So to that extent, we think that that may not necessarily be a significant risk, from a INR point of view. the key for us is really ensuring that our own growth stabilizes, right, and picks up. And if we can get some policy measures towards that, and some of the policy measures also have to be towards attracting flows into India, which means easing norms for foreigners, changes probably or relaxations in some other withholding taxes and stuff. So as long as we take measures which are helping us attract flows, I think rupee would be a beneficiary, especially if oil doesn't go up.
Okay, well, actually, I must point out, you may have come across
the whole election mandate is. And sorry, just to add, the election mandate is definitely a positive from a near-term point of view, right? In terms of ensuring that the message of a stable, strong government over a 5-year period. So that macro risk of any instability is now really past us.
Yeah.
So that's a very big picture positive for the country.
No, absolutely. We weren't rattled much even when the Turkish lira crashed. But I just wanted to say that 2 days back over the weekend, the former PBOC chief, Zhu, did mention that 7 is not such a big problem, even if the yuan went there. Some people in some forex markets have taken that comment very seriously. I mean, Zhu should not be taken lightly. That was seen as part of the veiled threats that came from China. But anyway, be that as it may, since you are confident of the currency, let me move to just one last question on liquidity. I mean, everyone keeps saying that liquidity is something the central bank should speak about. But at the moment, they have a mandate to keep the repo rate the call rate close to the repo rate. That's how it is working. It is no longer the old RBI where you had unlimited amounts of money being taken at the repo rate and unlimited amounts of money given at the reverse repo rate. At the moment, the yield doesn't go automatically to the reverse repo, no matter how many OMOs are done. The RBI ensures that call rate stays at repo rate. So, do you see the liquidity framework itself will be changed, debated? How will liquidity be provided?
I think the keeping the call rates close to the repo rates is not difficult to achieve even if you have positive liquidity scenario, right? The first positive thing towards that is the corridor itself is narrowed.
Yes.
Earlier you used to have 100 basis points wide corridor, so which meant that if you move to a systemic positive scenario, then you could have a big fall in on reverse repo yields, and that was questioned by some as a stealth easing and so on. Today the corridor is narrowed to 25 basis points, so it doesn't really mean that you're going to have reverse repo call rates fall very sharply. At best, it would fall by about maybe maximum 25. And there again, the RBI has measures, tools. For example, they can always conduct a daily reverse repo or a very, very short tenor, 3-day, 5-day kind of reverse repo auctions where people can actually place money with them close to the repo rate. So I think that's not necessarily a big impediment for you to take a policy action. I think the larger point is, in the MPC framework, once we move to the MPC framework with the whole primacy of repo rate and the inflation targeting, probably we probably don't have a forum which really looks at liquidity at the banking system or at the systemic level as an important point of policy measure or discussion. And maybe that's a framework which there was a debate sometime whether it's in the remit of MPC or the RBI and so on. I think the RBI is on the path towards improving liquidity. Already they have taken measures. The OMO, apart from the OMO tool, the swap window that they started in the month of March, I think is a very, very good, nice idea to supplement their tools to provide liquidity into the market. The key question really is, are they convinced that the system needs more sustained positive liquidity, and therefore can they front load some of their actions towards making that possible, and also giving the guidance to the market, saying that, hey, what, we feel that it is time we kept the system positively on the liquidity side, system positive on the liquidity side. If you just go back to 2016 April, at that time, for many years into that period, they were running liquidity on a negative bias. And in April 2016, when Dr. Rajan was the RBI governor, they explicitly came back and said that we will take policy actions to ensure that the liquidity moves towards a neutral and not in a deficit range. I think it's time that they did something like that, which is to say that from a neutral, we would like to move liquidity towards a positive zone.
Okay.
And that will be a very, very important signaling to the market.
All right, Badri, we leave it at that. So a positive communication, everything will hinge on the Reserve Bank's communication on whether it keeps liquidity plentiful. Thank you very much indeed for joining us. Have a good conference.